Welcome to Banking 101, a first principle jargon-free course on banking. In this lesson, we will define some key terms from first principles. First, we will define a financial asset. Next, we will define a financial product. Then, we will learn what the term financial services industry refers to. Finally, we will end this lesson with defining what is a bank and what is a fintech. Before we get to financial assets, let us talk about physical assets. A physical asset is an object that derives economic value from its intrinsic physical properties and can be sold for cash. The value of a home is derived from intrinsic physical properties like its location and the quality of its interiors. The intrinsic properties that determine the value of a painting are its aesthetic appeal and the fame of the painter. The value of gold is derived from the value that individuals attribute to its physical properties like weight and purity. Like a physical asset, financial assets carry economic value. However, a financial asset does not derive its value from its intrinsic physical properties. A physical share certificate is not more valuable than a digital record of ownership of the same company. Let us compare a home to a home loan. When we buy a house, we own the physical asset, the house. But it is the mortgage lender that owns the financial asset, the loan. The intrinsic value of the loan at any time is derived from its expected cash flows, not from the physical properties of the house it is financing. We can define a financial asset as a physical or digital symbol that signifies economic value, is accepted across a broad context, and that economic value is derived from a defined rule, instead of intrinsic properties of the symbol. We will now parse the four terms, economic value, broad context, defined rules, and intrinsic properties, to better understand this definition. An object has economic value simply if it can be converted to cash, goods, or services of equivalent monetary value with relative ease. Examples are cash itself and shares of a company. Broad context means that entities who accept the economic value of the financial asset, the potential buyers, are not restricted to a narrow geography or a specific marketplace platform like Amazon. To understand this better, next, we will look at an example. A dollar bill has universal value within the US and can be exchanged for foreign currency at a foreign airport. Its economic value is accepted within a broad context. But a poker chip has value only in the casino that issues it. A subway card can only be used in the subway of one city. We wouldn't call poker chips and subway cards financial assets. The context in which their economic value is accepted is too narrow. Financial assets derive their value from defined rules and not from intrinsic properties. To explain the difference, we will take the example of currency notes versus physical gold. The value of physical currency is derived from a simple rule: it is the face value printed on it. On the surface, the printed value may seem like an intrinsic property. But if you deposited the note into a bank, the value represented by that note remains the same even though you no longer possess the note physically. The real reason the currency note has value is that the government backs that currency. The value of physical gold, on the other hand, is derived from its intrinsic properties like weight and purity. If you deposited the gold with a bank, that gold bar needs to physically reside in a vault under your name. Shares of a mutual fund that invests in gold is a financial asset but not gold itself. Based on our definition, are currency, title to a car loan, and shares financial assets? Next, we will answer this question by applying our definition of financial assets to each. Currency, either in paper or in bookkeeping form, meets all the three criteria. It is a financial asset. The title of your car has economic value. Normally you will not transfer it to another person for free. However, the context in which its economic value is accepted is not very broad. It is restricted to the geography in which you are living because the buyer has to take physical possession of the car. Further, there is no rule that defines the value of a used car. We cannot say that the price of a used car should be discounted by 5% of its original price for every 5,000 miles driven. Rather, the price you will get for transferring your car title is dependent on the intrinsic properties of the underlying car. The title of a car proves ownership of a physical asset, but it is not a financial asset. While the title to a car is not a financial asset, the car loan is a financial asset owned by the lender. It has economic value. It meets the broad context criteria, even though that may not be immediately intuitive. If a car lender wants to exit the auto lending business, the potential buyer pool would not be restricted to a city or a platform like Amazon. Finally, the value of the car loan is derived from the pending principal and interest payments on that loan, not from the intrinsic properties of the car that the loan relates to. A share has economic value because it has a non-zero price. The pool of prospective buyers is not limited to a geography or a technology platform. Even shares of companies that trade on a digital exchange can be traded off exchange. Finally, the economic value of shares is clearly rule-based. For an exchange-traded stock, it is simply the ask price quoted on an exchange. For the stock of a company that has never been traded, it is the discounted value of future earnings. Of course, that is very difficult to calculate and people will apply the rule with different assumptions. But the rule exists. Shares are thus financial assets. The rules that drive the intrinsic value of financial assets can be grouped into 4 categories. They are government mandate, ownership claim on future cash flows, value of a predefined variable, and community consensus. We will look at each of these in brief. One source of intrinsic value is a government mandate, and fiat currency is a good example. The currency of a country has value because the government says so and it accepts tax payments in that currency. We purchase public goods like national defense and roads, by paying for them in taxes. Hence, fiat cash stored physically or digitally, is a financial asset, whose value is determined by government backing. A second source of intrinsic value of a financial asset is an ownership claim on a future stream of cash flows. Stocks represent an ownership claim of the shareholder on the earnings of a company. A loan is an ownership claim on a stream of payments from the borrower. An insurance policy derives value from future payouts. The intrinsic value of a financial asset could be contractually derived from the value of a predefined variable. The predefined variable can be anything that 2 parties agree to. Exchange rates, interest rates, commodity prices, and share prices are some common variables used within this asset category. Next, we will review an example of such a financial asset. A currency futures contract derives value from the exchange rate of currency. Say, a US manufacturer needs to pay €1 million to a European supplier in 3 months. To mitigate foreign exchange risk, it buys a euro futures contract, allowing it to buy €1 million in 3 months at a predefined exchange rate of 1:1. The seller of the futures contract is a currency trader. At the end of 3 months, the manufacturer delivers $1 million to the currency trader. The trader, in turn, buys euros from the market at the prevailing rate but delivers euros to the manufacturer at the pre-negotiated rate. The profit or loss made by the trader depends on the exchange rate prevailing at the end of 3 months. The trader could also sell this futures contract to another trader before the contract expires. The value of this illustrative futures contract on any day during its 3-month life cycle is derived from where other traders think the rates are headed that day. The fourth source of intrinsic value of a financial asset is community consensus. The result of the community consensus is discovered through a market price on an exchange. An example here is cryptocurrency. For our current discussion, it is immaterial what people think is the source of Bitcoin's intrinsic value. Its economic value can be determined from the price at which it is trading at a crypto exchange. A word on community consensus. The value of some financial assets is hard to determine. There is no easy way to estimate the future earnings of a company. Hence, the stock price on any given day represents the community consensus on a company's earnings prospects on that day. Similarly, the value of a currency will crash if people deem the state backing it to be a failed state. Hence, there is an element of community consensus across all financial assets. But in other 3 categories we just discussed, the consensus relates to the source of intrinsic value. In this 4th category, to which cryptocurrency belongs, the consensus relates to the value of the financial asset itself, and therein lies the difference. Let us conclude this section by making a list of financial assets. The major financial asset categories are currency, equity, debt, derivatives, and crypto financial assets. However, there are many forms in which these financial assets are actually expressed. Learning about all the expressed forms is outside the scope of this course. For now, we will just note the distinction between the parent financial asset type and its expressed form. Now that we have defined financial assets, we can define financial products as simply a service that performs one or more of 5 functions on financial assets. These are create, store, preserve, grow, and move. A financial product can create a financial asset. When a mortgage lender makes a loan, it creates a new financial asset. The product is a mortgage loan, the parent financial asset created is debt, and its expressed form is a loan. IPO underwriting services of investment banks is the product, the parent financial asset created is equity, and its expressed form is common shares. In our framework, the product and the financial asset has a subject-object relationship between them. The product, which is the subject, performs a function on the financial asset, the object. A financial product can simply store a financial asset. A non-interest-bearing bank account stores cash. A brokerage account allows us to hold equity and debt in the expressed forms of shares and bonds. A financial product can preserve the value of financial assets by protecting against the impact of future events. Insurance policies fit into this bucket. The financial asset preserved is cash. Financial products can grow the value of our cash by deploying it in financial assets that earn returns. Examples include savings accounts and mutual funds. Note that a financial product can perform multiple functions. A savings account helps us store our cash but also helps grow it. Finally, financial products can move financial assets between individuals and business entities. A brokerage service helps move ownership of equity, debt, and increasingly crypto assets. A debit card allows us to move cash to another party. The term product conjures up the image of a physical product. A financial product like a credit card can exist in a physical form or in a digital form. Hence, it is more helpful to think of financial products in terms of the aforementioned 5 functions they fulfill and not their actual embodied form. In this course, we will be using the term financial product in a granular manner. For example, we probably think of our bank account as a product, but we may not intuitively think of check payments as a separate product. But consider what happens when we write a check. The recipient of that check submits the check to her bank, which then submits it to our bank. Our bank then authenticates the check and verifies whether we have sufficient funds. It then debits our account and transfers funds to the beneficiary's bank. So, looking from a bank's point of view, it is a discrete product they are offering. In fact, some banks offer a no-overdraft bank account without checkbook privileges. Hence, the bank account, checks, overdrafts, and debit cards can be thought of as 4 separate products, even though they are often priced as a bundle. To recap, we first defined what is a financial asset. Then, we defined financial products as a service that performs any one or more of 5 functions on financial assets. We are now ready to define what is meant by the term, the financial services industry. The financial services industry can be defined as consisting of participants who earn majority of their revenues in one of 2 ways. 1. They provide financial products to customers. 2. They sell technology, data processing, and information services used in provision of financial products. A credit card issuing bank is a financial product provider. A credit scoring agency is a product enabler. For the purpose of this course, we will refer to product providers as Type 1 entities and product enablers as Type 2 entities. Type 2 entities sell to Type 1 entities. It is useful to think of Type 1 entities in 3 dimensions: the what, the how, and the who. Let us see how this works for a credit card. The first dimension is the what, the underlying financial need being addressed. In this case, it is the need to make a payment. The second dimension is how the financial need is being fulfilled, the product, which in this case is a credit card. The third dimension is who is providing the product provider, which is the credit card issuing bank. The card issuing bank is a Type 1 entity in our framework. On this table you can see some examples of Type 1 entities and the financial products they provide. Type 2 entities sell technology, data processing, and information services that are tailored to the provision of financial products. Hence, they are different from sellers of general-purpose technologies like cloud services or word processing. We would not call Microsoft a Type 2 entity just because every bank uses Excel. Type 2 entities are an extremely diverse lot. Hence, we will only share some illustrative examples. Type 2 entities include credit reporting and scoring agencies. These companies don't make loans but enable Type 1 entities to make better lending decisions. Another category of Type 2 entities are companies that sell technology platforms. For instance, most of us have bank accounts. These bank accounts are housed in a core banking platform. Sellers of these platforms would be Type 2 entities. Card network providers like Visa and MasterCard don't actually issue the credit limits and bank accounts associated with credit and debit cards respectively. Instead, they connect card issuers with the merchants, every time someone pays by a card. A number of payment technology providers provide the technical mechanism by which people can send money from one bank account to another. So let us now do a brief recap and clarify definitions of the 4 terms we are using in our framework to describe the financial services industry. First, Type 1 activity is the act of providing a financial product, for example issuing a credit card to a consumer. Second, Type 1 entities are entities in the financial services industry who earn majority of their revenues from performing Type 1 activities. Third, Type 2 activity is the act of creating technology, data processing, and information services products that are specifically tailored to enable creation and delivery of financial products. Fourth, Type 2 entities are entities in the financial services industry who earn majority of their operating revenues from performing Type 2 activities. The same entity can engage in both Type 1 and Type 2 activity, hence whether we classify them as Type 1 or Type 2 entities depends on where they earn majority of their revenues. We have now defined the financial services industry and the difference between Type 1 and Type 2 entities. We define the financial services industry as consisting of businesses who either create a financial product or enable the delivery of a financial product. But what then is a bank? We will define a bank in this section. Historically, banks were associated with taking deposits, making loans, and cashing checks. However, today banks may offer a wide range of products ranging from asset management, investment banking, and even insurance in some countries. If we define banks by what they do, we run into the difficulty of defining the scope of banking. Specifically, two questions must be answered. What are banks permitted to do? For example, can they offer insurance products? Second, what activities are only permitted to banks? For example, can an entity make loans but not be a bank? The answer to both these questions vary by country. Hence, we will not attempt to define banks by the scope of what they do. A bank is simply an entity that has a banking license issued by the relevant regulatory authority, regardless of the criteria applied by the regulator in issuing the license. The assignation of a banking license confers a set of privileges and restrictions that vary across countries. However, for the purpose of this course, a bank is defined as any entity that is designated as a bank by the regulators of the parent country. Banks are thus a subset of a broader set of entities that together constitute the financial services industry. At this point, we can also define what a fintech is. Fintech is short for a financial technology company. We can define fintech as a Type 1 or Type 2 entity that heavily relies on the differentiated quality of its technology to deliver its services to customers. Fintechs may have a banking license. A banking license allows a fintech to offer a wider array of products but imposes greater regulatory burdens on them. Sometimes the term fintech is used to refer to businesses that are not financial services businesses but offer financial products. We will discuss these businesses in the next lesson. If we go back to our circle, fintechs can exist within the inner circle or outer circle depending on whether they have a banking license or not. This brings us to the end of this lesson. Review the summing up section next and proceed to the next lesson.